What if the index fund you trust for diversification is actually more concentrated than you think? Right now, the S&P 500, long considered the gold standard of passive investing, has become notably top-heavy, and every investor should understand why. A small group of AI-driven mega-cap companies currently makes up a historically large share of the entire index. That means when you buy a standard S&P 500 index fund, you're not spreading your money evenly across 500 companies, you're heavily weighted toward just a handful at the top. This is called index fund concentration risk, and it's one of the most important passive investing risks to understand as we look ahead. Think of it this way. If those top companies stumble, the entire index feels the impact, far more than most investors expect. As Warren Buffett has long advised, diversification is protection against ignorance, but only if that diversification is real. So what does true stock market diversification look like when the S&P 500 itself has become concentrated at the top? One increasingly popular solution is an equal weight ETF, a version of the S&P 500 where every company holds roughly the same share of the portfolio, regardless of size. This approach reduces your exposure to any single stock and gives smaller companies more influence over your returns. Another strategy is international diversification, spreading investments across developed and emerging markets outside the US to reduce dependence on any one economy. Benjamin Graham, the father of value investing, reminded us that the intelligent investor never puts all their eggs in one basket, even a very popular one. None of this means you should abandon index fund investing. The long-term track record of broad market index funds remains one of the most powerful wealth-building tools available to everyday investors. The key is understanding what you own and whether it truly reflects your risk tolerance. Compound growth still works the way it always has. Time in the market, not timing the market, is what builds lasting wealth. But compounding works best when a single rough stretch for a few mega-cap stocks doesn't derail your entire portfolio. As you look ahead, consider reviewing your index fund holdings and asking whether adding an equal weight fund or international exposure could help smooth out your risk. You don't need to overhaul your strategy. Small, intentional adjustments are often enough to build a more resilient, diversified index fund portfolio. Peter Lynch once noted that knowing what you own and why you own it is the foundation of every successful investment plan. The goal isn't to chase performance, it's to protect the wealth you're already building while staying invested for the long haul. If this breakdown was useful, hit subscribe and like the video for more straightforward investing education built for beginners and long-term thinkers alike.